Let's go. We are back in the house. Welcome, everybody, to the Thursday edition of the Not Your Average Investor Show. Today, we're taking a look at what are these properties just hanging around Jacksonville going to be worth in the next 20, 35 years, right? Like if I was to buy a rental property, or if I own a rental property, which I do.
Yes, you do.
I want to know exactly how much cheese that's going to get me over the next 20, 35 years and how much cheese it's going to make monthly in 20 to 35 years. I think it's going to be pretty exciting. I'm your host, Pablo Gonzalez. With me, as always, back in studio, we are the dream team is together. GC, the man I call GC because of his genius concepts, because he generates cash flows, because he's got great co-hosting skill sets, and because his name is Gregg Cohen. Say hello, Gregg.
Hello, everybody. Fantastic to be with everybody. Fantastic to be with you in the studio, buddy.
It feels good, man.
It feels right. That's why we matched shirts today, too, because we were so right.
God, I hope Hervé's here. And with us, as always, our phenomenal community manager. We call her MTM because she brings us the moment that matters, and because the community has nicknamed her Madison the Magnificent. Say hello, Madison.
Hi, everybody.
And we love having y'all here, right? We are so pumped that the community is live in the house. If you're joining us on the podcast, or you're joining us live here, or if you're joining us on YouTube Live, go ahead and subscribe to the YouTube. We've put a bunch of extra little improvements in YouTube. We're really breaking down the best moments. So if you don't have an hour to watch the whole show, the 5 to 6 minutes, golden nuggets, we're breaking those down. We've got better thumbnails coming up, better titles, better descriptions, a whole bunch of cool stuff is happening on the YouTube. So if you like the YouTube, go to the YouTube. Hit subscribe.
I feel like that's our parents talking about the YouTube.
Yeah, that's why I said it. Hit subscribe, hit like on a video, leave us a comment. We'd love to have you in there. But more than anything, we love having you here. Yes, for what, GC?
Well, a lot of good things. Which are we talking about first?
How we like to kick things off?
Yeah.
The robot.
Well, I know, but are we going to talk? Do we have any good news that we're sharing? Do we have any breaking
good news?
No way.
He hasn't been here for a while.
Oh my goodness! The roll call, baby.
I remember my first Not Your Average Investor Show. All right, here we go. We got Lita Song in the house. Lita, we love seeing you here. Always calling us beautiful investors from Minnesota.
Thank you, Lita.
Appreciate that, Lita. We got a leadoff hitter,
John Henning.
Lita and the leadoff hitter, John Henning.
Love that.
We got Big Papa in the house. We love it when he calls him Big Papa.
Pops, good to see you, my man.
J. Cohen, Gregg's dad. We got the MVP. You may have heard of him.
Lee Bishop.
Lee Bishop, of course. We got the shaman of the Pacific Northwest. We got the mama bear of the community.
Cody Adams.
Cody Adams. We got the fairy godmother checking in from warm, sunny Monterey, California.
Good to see you, Jen. And Jen fills in. And Jen, just so you know, we're working on that date. I want you to know Jen is so fired up for the next meetup that we do, as I hope you all are. Just know. We're figuring it out. We'll get it out there soon.
She is not the only one that's fired up, my friend. We've got, many requests about this thing. And we also got the
Billy Green
from the Sasquatch invested mountains of Colorado. Good to have you, Billy Green, in here. We got the man that everybody knows. He's back.
Noah Rundari.
Greeting from California.
Good to see
you. Got Marilyn Cotterman from Homosassa, Florida.
Home of the manatees, brother.
The manatees. I bet the manatees are starting to gather right around, but it's right before winter.
Course.
We got, he's here. Hervé Francois, our old boy in the house.
What do you think, Hervé?
Matchy, Hervé.
Hervé always knows when we match.
I didn't get the memo.
You didn't get the memo. We got Leo Faragana.
Dun, 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 dun.
Faragana.
Dun, 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 dun.
Leo, good to have you back in the house. Let's rock, buddy. We got Layla Powell, the all-star teammate in the house. Good to have you.
JWB.
Yeah, there you go. Representing JWB. Who else we got? Louis Huddle, formerly from California. Good to have you, my friend.
I just jumped on that one. I didn't know if I was supposed to do it with you. Okay, cool.
You're back. You're back in shape. What is it? But Lewis moved to Rockway. I know it's something that's Rockin' and Rockland, something like that.
Yeah. All
right,
we're keeping tabs.
Yeah, we're keeping tabs over there. We got the first family in the house, the patriarch and matriarch of the first family, Ken and Carolyn Moline.
We salute you.
Good to have you. We got Pamela Myers in the house.
Fantastic.
Is back from the Seattle area. Pamela, good to have you. Man, I love the energy of being next to you here, GC. This is great.
This is such a good time.
Mark Larrett saying good day, people.
Mark, the name is familiar. I'm not going to say it's a new name, but it is a wonderful privilege to have you here, Mark. So thanks for being here.
Mark, I hope you make it. I hope you make it a tradition. We got Maria Totino is back from sunny West Palm Beach. Maria finally sunny West Palm Beach. I'm assuming we had some bad weather down there, Maria. I'm glad that it's shaping up for you well. We got JC in the house with a good morning. Oh, we got Greg, number one.
Oh, the better Greg.
The better Greg.
Fantastic.
Greg Stiller from New Jersey.
Has the better Greg been around when I have not been around recently?
He came to one or two.
Okay.
Oh, JC is Jag, milady Jag.
Oh, fantastic, Jag.
Jag, who recently became an investor.
Yes.
Jag.
Well, Jag's been an investor for quite a while, but she just added a couple more properties. So congratulations. We're so excited to continue to serve you and your family.
Love it. Love it. Love it. All right. You know what happens after the roll call?
I mean, I've been so excited to hear the good news.
It's my favorite moment of the week.
Yes.
It's when Madison shares good news. What's the good news, Madison?
All right, everybody. A typical case of under promise, over deliver here. Our team, as everyone knows, Q3 just ended, and our team, multiple teams, have just knocked their goals right out of the water, not only to better the company, but also serve you guys. So a team that I really want to recognize who has a really big impact on your returns is our turn team. Our turn team hit a world record last quarter and closed 328 turns in 3 months with an average of 11 days per turn. So not only did they blow everybody out of the water, they got 328 homes back on the market and ready to be rented for you all in an average of 11 days.
You know, those stats right there are so critical, because if you think about owning a rental property, the most painful time that you'll have as the owner of a rental property are those days when the resident has left, when the home needs to be turned over, new things need to be done to the home to bring it into great rental shape, and then it needs to hit the market very, very quickly. So big kudos to the property turn team. And those are the things that matter as a rental property investor. It's not just when things are going well, it's when you do have that move out, how quickly, how devoted is your vertically integrated team to count the number of days and track the number of days and get it back on the market. And our property turn team, of course, that's how they roll, baby.
Yeah, and while you were away, GC, we had Ali King on the show. Right? I was actually just quality controlling that podcast episode, talking about the dynamics behind it, talking about this idea that, listen, 328 turns in 3 months don't happen without some serious strategery and leadership.
Yeah,
I was really shocked at the amount of specialists that you all have dedicated within the turn. I think I counted 4. It was like the proposal, the scope sheet specialist. That one shocked me. There was like another like inspector and QC person. There was I'm like losing track, but there was like 3 or 4 specialist roles, all designed to make that 11-day turn really truly happen. And it was like completely mind-blowing and a new kind of like redefinition of why the economies of scale of JWB and the vertical integration of it works so well for investors.
Well, and I think if you're trying to invest and you want a great experience with something like rental properties, in order for this to work really well and meet those expectations, there probably have to be 4, 6, 10 specialists that are highly trained, highly awesome at their jobs that you never even knew that role existed. You never even knew it was necessary, right? But that your vertically integrated provider, of course, knows it's necessary, has already built the systems, has trained, has gone through this. This is not their first rodeo. And so then it just happens. You just think it happens in 11 days or 9 days or however many days it takes, right? And then, you know, it works, but you don't realize. And that's why I'm so happy that we had Ali on the show and she was able to speak about all the 100 teammates that we have here that work behind the scenes that make this thing not just profitable, but enjoyable for our owners.
Amazing. 328 turns in 3 months. Madison, you know what we call that?
Good news.
We call it good news. All right. Okay. So now let's get on to, wait a minute. You see, we got something else. We got breaking news also.
Extra beeps on this one too, right?
I was really worried about my throat there.
Yeah, we got some really great news to share with everybody. You know, I just love the shows that we did while I was taking a little bit of a hiatus here. A number of those shows were talking about downtown Jacksonville and the Pearl Street district. And we got to, You all got to meet Brian Mole, who's the CEO of Gateway Jacks. You got to spend time with my business partner, Alex Safakis, who's the president of JWB. And we finally were able to unveil what we have been hinting at here on the show for a long time, which is significant investment in downtown Jacksonville that JWB is a sponsor of. And that Pearl Street district is a $500 million initial investment right in the North Core, right where JWB has been, investing, where we have been hosting our tour.
That's right.
In downtown Jacksonville. So we were able to unveil all of that. Well, that is super exciting. We're going to continue to share more and more about that. But, JWB has started this process of not taking down these old buildings, started the process of investing in historical renovations downtown. How about that? Did a good job there.
I like that.
It's for about 3 years now. And so, it takes time for these things to come to fruition where not only are they purchased and funded and renovated, but now we have successes. And so I wanted to share one of these successes with you. For those who were here on the last Not Your Average Investor tour that we did way earlier this year, we spent time in this building. It's called the Federal Reserve Building. And for any of you, if you remember, it was not done at that time, right? It was in the process. You could see it, but it was not done. So you got to get a sneak peek. Well, guess what? The Federal Reserve Building that JWB owns is done. It's been completed. And it's leased out.
Let's go.
It's leased out. There have been a number of big wins for downtown Jacksonville, specifically for JWB properties, and the Federal Reserve Building is one of those big wins. There was an article that was just written about in the Jacksonville Business Journal. So Madison, I don't know if you have that link handy, but let's add that one to.
I have the link handy.
You got it. Perfect. Yeah. Thank you, buddy. You guys can read all about it. There are some things that I can't share about it. The Business Journal gets ahead of, they're really good at getting information. So I can't share who the tenant is, who is occupying the building, but they're occupying all 3 floors and the courtyard, the beautiful courtyard that we built right outside. Again, this is a courtyard that's
so single tenant.
Yeah. One tenant for all 3 floors.
Interesting. Right. And listen, I don't think no offense, but I don't think you're doing a good job of painting the picture of what this building is. You're talking about it as somebody who's been develoling it for the last 3 years and you know it intimately.
Love it.
This is this historical old.
Bring up the link. You can see a picture then.
You know what?
It'd probably even be better than you doing it. Picture is worth 1,000 words there, Pops.
My only problem. Oh yeah, perfect. Yeah, perfect. So we're going to show it here. It is this beautiful historic bank building that is across from City Hall. And it's basically 3 floors up here. There's a beautiful event space way up here and just a wide open, double-heighted ceilings, as you can tell in these windows, these incredible, old ceiling finishes that you just can't make these days, and a super cool little basement that I know was kind of earmarked for a speakeasy. So, and then of course there's the courtyard right next door where you have this activation that connects the 2 buildings with Sweet Pea and the other, what's the other one called?
Well, there's Sweet Pea and then there's Church Street, which is a perfect segue to talk about that one too.
Yeah, and Church Street. So I'm just very curious I know you can't tell us, but I'm excited to find out whatever tenant is going to take that all in one spot has to be a really dynamic filler of that space. So I can't even.
It's a big commitment for someone to take the entire building down.
Yeah.
That shows a lot of belief in downtown Jacksonville, which is what you're seeing. And we've been shouting this from the rooftops for years and years and years. And, I'm excited to show you the fruits of all of that labor, because this is not just a win for JWB, right? This is the win for downtown Jacksonville. The more buildings that are renovated or even newly built that are then leased with wonderful commercial tenants or retail tenants, that's belief. That's stacking victories for downtown Jacksonville. And the reason that this matters for all of us who are investors in single family rental properties is that when downtown continues to have more and more wins, you can think about median incomes raising in Jacksonville. And this allows for higher than normal rent and home price growth for the neighborhoods that we invest in as a JWB investor, which are surrounding downtown, those workforce neighborhoods that surround downtown. So incredible victory here. I will also add that you mentioned the Church Street, 218 Church Street.
I'm going to show it, right? So the 3 buildings, this is the Federal Reserve here. over here is Sweet Pete's, and then back here is 218 Church Street, and this connects the three. And what's going on at Church Street?
Well, I haven't updated you there either, but guess what? That is fully occupied as well. So 218 Church Street is 24 apartments up top, and then it has 3 retail spaces below. And so we leased out those 24 apartments. We've talked about how important population growth is downtown. Well, there's 24 apartments. That's probably 40 folks, somewhere around there, that 40 new residents moving downtown. Yep. And it leased out very, very quickly. So these 3 buildings that we have with this courtyard now are not just built. They're not just beautiful for downtown, but they're thriving economically. They're success stories. Yep. And then when people see these success stories, the next developer is much more likely to come in and take on that next historic renovation project, and where we can all win together, and the city can win, our residents can win here in the community, and you can win as an investor in those neighborhoods that surround downtown Jacksonville.
Success begets success.
Yeah, baby.
Right. I love it, man. I love it. And something along the lines of downstairs is a florist, right? There's 3 retail spaces.
Yes. So we have 3 spaces. One is occupied by a florist. Mm-hmm. This is in 218 Church Street. The other 2 spaces are commercial. I'm sorry, not commercial. They're restaurant spaces.
Oh, cool.
Yeah. And I can't really share much of the details on those 2, but we're pretty close to having some fun news to share there too.
Interesting. So those 48 residents, give or take, that are moving into 218 Church Street, they're about to, have 2 dining options downstairs, Sweet Pete's right next door, which is a really, really cool space. The Plaza, James Weldon
Johnson Park, right across from City Hall.
Yeah, like a corner from City Hall, and then whatever super cool tenant is going to take over like a historically renovated building with a speakeasy downstairs.
Yes. And then this Pearl Street district that Brian Mole and Alex just shared, and we just unveiled to the entire city. That's literally the next block over.
Yeah.
So it is an exciting time for downtown, and for so long, it's been just a vision. It's no longer just a vision. Things are happening, and as an invitation, when we do get the date, hammered down for the next Not Your Average Investor tour, we're going to make sure that we go and see some of these success stories. So you guys will get to see this in real life. So that'll be sometime in Q1. Pablo and I and my team will knock that out and share that with you soon. But so much fun to see the success, and I can't wait to share it with you guys in person.
Sounds exciting. All right, Justine, let's talk about what we came to talk about, right? I think it is a normal thing to ask, right? We got these single family homes right now that are probably about an average of a $250,000 in worth. If I were to, I think people might think, well, is the market topped out? Mm-hmm. They might think, well, maybe I've lost all the appreciation. Maybe the next 20 years might not look as good as the last 20 years. So let's future pace a little bit. Let's look into the future of what one of these homes would be worth. And let's look at it from the prism of what would it look like if I'm picking it up right now, right? If I'm investing in it right now, so that it's even harder, the numbers, as opposed to just if I already owned it, right?
Yeah.
All right, cool. So
100%.
let's, I welcome you back with your spreadsheet making, not spreadsheet making. You love to make these PowerPoint presentations that help us all understand a little bit better. And it starts with this.
Well, anytime that we start sharing real numbers with you, obviously I'm going to share with you what properties will be worth in 20 years. Jacksonville properties that you all are investing. These are based on historical assumptions. And anytime I'm going to share numbers with you, guess what? You should do your own due diligence. I'm doing my best up here. Pablo and I are doing our best, but we're not financial advisors. We're not giving you financial advice. Just handle this like you hopefully are handling your other financial decisions, which you should do your own due diligence. You should consult with experts and make your own decision. But with that being said, I'm excited to share some of the numbers.
Let's do it.
So I think the first thing when I was thinking about what show should we do today, I'm always thinking about what questions or what aha moments or wow moments do I get to hear from clients or, folks that I get to speak to. And one of the things that I have seen consistently is I start to project what home values will be or what home rents will be in the future in 10, 20 years, maybe longer segments of time. And people look at me and they're like, wait a second, the home's really going to be renting for that much? Or they look at me and they say, well, the home's really going to be worth that much, Gregg? And so maybe some of you will have a similar, kind of crink in your neck when you look at these numbers. And it's a it's an eye-opening experience, and people start to think, wow, is that real? What is that base? Is that real? Can I count on that? And so, I thought today we would share some of those numbers and talk about why we can count on that. And I can share my real world experience of doing this for 17 years and having my money on the line as well. But we can also look even beyond just my experience and talk about why you can count on some of these things, given a long horizon, a long buy and hold horizon. So that's really the genesis of it today. So what I did here is I just took a typical property. This is a typical JWB rental property that any of our clients are purchasing right now. And the purchase price might be around $250,000. With that, the majority of clients are using conventional financing. And so you might put down, let's say $100,000 for that total purchase. And so if you're relatively new to this space, right, what we're talking about here is you putting down $100,000 of your own money. That is your investment, but you're controlling the whole asset, and the whole asset is worth $250,000. And so you putting a smaller amount down, but controlling the bigger asset here is really critical, because as that bigger asset goes up in value, your return on investment skyrockets. And it's not just because of a great return appreciation rate, it's because of that appreciation rate. And also because you only had to put a smaller part of your money down to control it. And so in this example, you put down $100,000, your monthly rental income for a property that's a $250,000 property, somewhere around $1,450. And that's today for the property you would purchase today from JWB. Yep. And the market value of your home, of course, is $250,000.
And I'm assuming, GC, that we're using this $100,000 nominally in order to make it a nice round number. You can put down less, you can put down more. It'll affect the numbers. You're still getting leverage. This monthly rental income of $1,450 for a $250,000 house, that's a real number,
yes.
Right? That is.
I ran this in actual numbers here off of a real property. Okay. I just didn't add the 72 cents and things like that.
I gotcha. So this is a real numbers on a property. It's the down payment that can change if you want to engineer the numbers to do more cash flow, less cash flow, more leverage, less leverage.
Exactly. So this asset is one that pays for itself every single month. There's positive cash flow, but yes, you could put down, as little as probably $50,000, give or take a little bit, if you wanted to put down less.
Cool. All right. So should we fast forward to the future, 20 years?
I think so. So that was date of purchase. Now let's fast forward 20 years and see how this thing shakes out. Your purchase price, of course, was the same. And your down payment was still the same. That's your initial investment. You invested $100,000 here, but you control a $250,000 asset. And guess what? Your monthly rental income goes up a lot. It more than doubles here in 20 years. And that is based on Jacksonville's historically accurate home price appreciation rate. If you go and look back over since 1985, Jacksonville rents on average have appreciated at a rate of 3.6% per year. So you just take that 1,450, increase that 3.6% per year. And in 20 years, you can see that you've more than doubled your home price, your rent.
Yeah. So, you're basically going from $1,450 in rent to $2,941. This reminds me of kind of like when we used to do the old properties of the week, how we would talk about not when we do like the investor stories and you're building out someone's plan and you talk about this idea of, your cash flow today is less important than cash flow tomorrow. And if somebody nominally thinks to themselves, well, I want to have $10,000 a month in cash flow. Why am I even messing around with something that's giving me $150 a month in cash flow right now? This is what we're looking at. We're looking at, it's not about right now. It's about when you need that cash flow, it's going to be there for you because rent goes up.
Exactly. Right. And it's not just that rent goes up, it's that your expenses, your major expenses actually stay flat. So that's where that cash growth portfolio that we talk about comes into play, because at $1,450 a month, you might be break even cash flow or slightly positive. But if most of your expenses stay the same and you double that, now it's almost $3,000 a month. Well, boom, that's how you can create thousands of dollars a month in free cash flow for your rental property.
Yep. So here you're at a, even more attractive cash flow position because your costs have stayed the same. And oh, by the way, your net worth has almost tripled.
Yeah. And this is using the historically accurate home price appreciation rate for Jacksonville. And this goes back 40 years, since 1982. Mm-hmm. And actually, this is actually based on 4.8% home price appreciation. The actual average for Jacksonville is 5%, but my team, we like to underpromise and overdeliver. So I used 4.8% appreciation year over year over year for the value of the home over 20 years. And, guess what? It goes up to almost $640,000 is what it would be worth in 20 years. And this is why I go back to what I was just talking about being so important, right? The down payment that you have is $100,000. You put $100,000 into this asset, but you get to control an asset that's worth $250,000. Mm-hmm. And when that $250,000 asset appreciates at 4.8% per year, you earn all of that appreciation. But again, your amount invested is relatively low compared to that. And so that's why your returns on investment here are much higher when you own a portfolio of single family rental properties. It's because of the appreciation rate, but it's also because of the leverage component, right? What other asset that can you take that, you put $100,000 into and it's worth, about $640,000 in 20 years? Well, that's a really great return. There aren't a whole lot of assets that can do that by themselves.
Yeah. Yeah, indeed. A couple of questions here. Michael Santorios, patron Santorios of the Not Your Average Investor Community.
There we go.
Asked, what % of that appreciation is inflation versus appreciation?
So that's a good point, right? So I actually looked this up. According to the Bureau of Labor Statistics, the average CPI has been 3.7%. I don't know how far that goes back. So if you think, inflation is roughly 3.7% on average each year, your home values, your appreciation rate is actually higher than that. Mm-hmm. And then when you couple the leverage component into it, it actually takes your return on investment much higher than 3.7%.
Yeah. And at the end of the day, I think inflation is going to happen no matter what, right? So inflation is going to happen no matter what. What I've grown to understand here is that you will inevitably beat inflation with this stuff, right? Because these are hard goods that people are buying. And if things are getting inflated, it's at least going to keep up with it. And on top of that, it's levered. If I'm in the stock market, if inflation is 10%, the stock market could still be a 7%, could still be 7% appreciation. Whereas if inflation is 10% in home purchases, the home purchase is going to go up at least 10% too because of inflation.
Let's talk about why that is, because I think that was a really cool moment as I was sharing why that happens, right? So why do we talk about real estate being a hedge against inflation, whereas the stock market is not necessarily a hedge against inflation? In the stock market, you have to buy more stocks, in essence, to hedge against other stocks. Mm-hmm. But in real estate, one asset is a hedge against inflation. And the reason is because when you buy a hard asset like a property, that is the sum of all of these hard actual parts, right? The building materials, right? The plumbing, the drywall, the roof,
the garage door.
Yeah. And so if you think that those things are susceptible to inflation, which they are because they're hard materials, that they go up in value. And then if you actually believe that a home builder is still only going to operate if they make a profit, which is what's going to happen, then that in essence is why real estate is a hedge against inflation, because the values go up as the cost of goods and services go up around it, right? And so, with that being said, real estate is a hedge against inflation. Other assets, paper assets, aren't necessarily a hedge against inflation. We can look at the fact that, inflation was 9% in the middle of last year. And if you look from last year to this year, how the stock market has done, it's still hasn't hit. It's down from what its previous high was in last year. So inflation,
while properties have been appreciating at like 10 plus, right?
Exactly. So, and that's a recent example. But if you look over the years, over decades here, there's a reason why, generally speaking, home prices go up 3 to 4, maybe 5%, depending on the market. And, inflation has been somewhere around 3-4% as well. It's been proven decade over decade because the fundamentals reinforce why home values go up if the cost of goods and services around that house go up as well.
That makes perfect sense, man.
Yeah.
But GC Murph Hayes says flat expenses. I thought insurance and property taxes had big jumps over the last 3 years. What do you mean by that, man?
Yes, that's a good point, Murph. So when I'm talking about expenses, I said the majority of your expenses stay the same. And that's true because the majority of your expenses actually are your principal and interest payments on your property.
Yep.
So not every expense stays flat. I wish it would, but not every expense stays flat. But these numbers and all of the projections that we put together for all of our clients assume that your mortgage stays flat in future years because it's a fixed rate mortgage and that's what we're going to put you into. But we also assume that your other expenses go up 3% a year. And so we do account for other things like taxes and insurance going up over time.
Yeah, and I think just to put like real numbers on that, do you see it? I don't know if you can do this off the top of your head, but like, what is an expensive kind of like yearly insurance cost? Like let's go, like the yearly insurance cost for one of my homes might be like $2,000, something like that.
No, I haven't seen a $2,000 insurance expense on one of our JWB homes in quite a while.
Okay.
I mean, the most that I'm seeing is, I don't know, maybe 1,500.
So 1,500 that went up from like 800, which is like double. Right? Like huge up,
Okay.
right? But let's call that. So that went up $700. Your monthly mortgage expense is $1,000.
Yes. Good point. Right.
So we're talking about like a cost that is 12 times a year that happens every single year versus a one-time cost that goes up for like one-time costs. And it might be sticker shock that it went up $600, but that major cost, that is the biggest thing that you pay every month for 30 years, that's consistent.
Yeah. And it is not normal for insurance to go up
Correct.
like you described. I haven't seen it go up like
Correct.
that. Certainly not very often. And, insurance costs, can actually go the other way too. We've seen a significant increase in insurance costs. There's hope that those could go down. So, what we're doing here is we're estimating over time. If you look over the long haul, your property taxes and your property insurance costs go up roughly around 3% a year. And so that's how you want to equate for that.
Yeah, cool. I just wanted to illustrate that idea of like what we're talking about is the major expense that's going to happen all the time.
Yeah.
That thing stays. Yes, there are other expenses that, like when you look at one increase every 4 or 5 years, it feels like a big increase. But when you think about it in context, right? If you're thinking about the pie, the Pac-Man stays the same.
Yep.
Right? Like of cost.
Yep.
Cool. All right, GC. I think you also have here with a 35-year outlook. Do we want to look at these numbers?
Well, I wanted to go a little bit farther out too, because what's really exciting about holding this thing for longer than 30 years, Pablo?
Being done with your mortgage payment.
Yeah, you don't even have that mortgage payment anyway. And who paid it off for you, by the way?
Your resident.
Your resident paid it off for you, by the way, which we love and say thank you for. So if you're 35, you still had your down payment of $100,000. You still controlled this asset that was worth $250 at the time that you purchased it, but your gross rental income has now skyrocketed up to $5,000 a month. What do you know? It landed right on $5,000 a month. I didn't actually plan that. It just came out that way. You guys can run the numbers. $1,450 for 35 years at 3.6%. You're earning $5,000 a month in gross rental income. Now you don't have that mortgage payment. And so not only do you have the net increase of your free cash flow coming from, rents going up, but you also have significantly decreased your major expense as well. It's no longer there. And so the vast majority of that rental income at year 35, when you really need it, is now free cash flow, baby. That's what you can use to support your lifestyle in retirement. And this is just one property.
Amazing. So now when we're talking about this idea of like, I want to get to $10,000 a month in passive income by the time that I'm retired, and why would I buy something that gives me $100 a month right now? It's because when you are retired, if you have $5,000 a month coming from one property, now you're halfway there.
Yes. Yes.
Right.
And if you compare this to other assets, right, the type of growth that you get is one reason why we love this asset class. But, when you get to retirement, it's about lifestyle at that point, and it's about income that you're able to support your lifestyle at that point. And there's not another asset that comes to mind that grows like this way in a risk mitigated way. Generally, when you're thinking about the type of income you can earn from your investments when you get to retirement age, your choices are pretty limited because you don't have a lot of time to lose money. If you put it in semi-risky things, you might have a trip, stumble, fall, and you don't have the same amount of time that somebody in the 30s, 40s, or even 50s might have to recover. So what do? You put it in very conservative assets and you accept a very low return on investment because that's the safe, conservative thing to do.
Mm-hmm.
So by owning a rental property and buying it and holding on to it for a long time, you kind of like supercharge this whole process. You bought a property that has grown in cash. Your free cash flow grows every single year because of inflation, things that you want to get behind, right? You don't want to be fighting inflation. It'd be nice for inflation to be on your side. Well, inflation is on your side when you own a rental property. So rents go up. And then you get to year 35 and you don't have to basically accept a lower returning asset just because it's conservative. You invested wisely, you held on to it for 10, 20, 30 years, and you're earning that type of income that you need without having to take outsized risk to do it. And that's one of the reasons that I love this. It's one of the reasons I started to invest as early as I figured this stuff out. It's because, this is just going to get better and better returns and reduce risk more and more as I get into, retirement age for myself.
Makes a lot of sense, man. We haven't even hit the fact that this home is now worth $1.2 million.
Oh yeah. We didn't even talk about that, did we?
So, I think when we're thinking about this idea of net worth that you're trying to save up to, and you have this like daunting idea that I got to get to like $5 million before I retire. Right. Yeah. If you start breaking it down and think, oh, okay, so like 5 of these $250,000 JWB homes is going to get me to 5 million plus in net worth in 30 years. That's really, really attractive, right? Like that to me is way more approachable than like thinking, oh, I need to just figure out what mix of like stocks and bonds and blah, 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 blah. That's a really nice round number to think that these things are going to be worth $1 million when everybody is shocked that they're worth 200 right now.
Yeah, guys. I mean, and this is what it looks like to buy and hold a $250,000 asset that's going to appreciate, call it around 4.5%, 5% a year. And you run these numbers, this is one asset that will be completely paid off by year 35. Yeah. That will be worth somewhere around there based on historically accurate assumptions. So, this idea of us getting to become, a millionaire or having $1 million in assets, you buy and hold the right asset in the right market with the right team, and you hold on to this thing and you're there. Now, I will point out though that, other assets that you could invest in, like stocks, bonds, mutual funds, and whatnot, if you started running these numbers out for 35 years, yep, you would get equally impressive numbers here. Mm-hmm. But here's the difference. To buy this asset, you only had to put down $100,000. Yeah. To get the same million dollar number or whatever number we're coming up with in year 35 for stocks, bonds, mutual funds, or what, you don't get the benefit of leverage. So you'd have to put $250,000 in order to get that type of stock value using those types of assumptions. So the value of leverage is the big differentiator between other assets, all the while, because you have growth in that asset, appreciation happening, coupled with that leverage, you're able to put together a $1 million portfolio, and this is just one property. On average, clients own about 3 properties, and many own 10, 20 properties with us. So you can start to do the math, and it's really, really exciting for JWB clients.
That is super exciting. So Jen is putting here in the chat. So if I buy 30 properties, Renee and I are going to do very well in retirement. Yay! But here's what I'm thinking. Jen has 7, right?
I believe so. Yeah.
So Jen, very realistically, in 30 years, if you multiplied these numbers by 7, she could be at 35,000. Like if her 7 average 250 grand right now, mm-hmm, and she's already in, mm-hmm, right? Like she could very realistically in 30 years be worth $8 million and have 35 G's in cash flow.
Yes.
It's crazy.
Yes. Now here's a little bit of a caveat though. Yeah. We think in terms of dollars today. So 35 grand a month today is like awesome, right? And we think about $8 million of assets as awesome. And by the way, those are awesome no matter if I'm talking about today, 5 years, 10 years, 20 years, or 30 years. But what we also need to take into account that we're not going to think that's as awesome 35 years from now because inflation is going to happen and our expenses are going to go up. It's like, if you really want to think about what we thought was awesome 20 years ago, it would have been a much, much lower amount per month. We would have said, wow, that's awesome. So this is not to take away from that, but to point out that you got to have your money working for you similar to this to account for inflation in the future. And there's no better asset that is a hedge against inflation than rental property. So I hope I didn't take the wind out of the sails of how awesome that's going to be for Jen and Renee, because that's going to be awesome no matter which way you slice it.
Yep.
But it's also just a challenge to everybody. Start thinking about the fact that, like, you know, $1 million, while we all think that is incredibly awesome today, you're not going to think that's that awesome in 35 years because the cost of everything else is going to go up so much that, you know, being a millionaire will not be what it is today.
Yeah. Reminds me of like that scene in Austin Powers with Dr. Evil when he's like, $1 million. And everybody like cracks up about it.
Right.
Because it's not worth that much.
Yeah.
Cool, man. You know, I guess the last thing before we get into questions is the idea that you're saying that these numbers get more attractive because of leverage, right? So if I'm going back there and I'm looking at this stuff and I'm rewatching this video, I'm poking around and saying, okay, so, you know, if I had $100,000 right now, or if I'm making an investment decision, I'd be thinking to myself, I have $100,000 right now. What does the projection, right? Like, what does the conservative projection tell me it's going to be worth in 30 years? And what does the conservative projection tell me that I'll be able to get cash flow from it in 30 years, right? And by that, I mean, if I was to find a vehicle where $100,000 leads to 1.289 million bucks, and then I was to take that $1.298 million and put it into a cash flow bond, you know, what would that yield?
Yeah.
Right. So like, and I guess bonds right now are 3 to 5%. So those are the numbers that I would be playing with. I think here, this 5,000 is somewhere, it's north of 4% for sure. And somewhere south of like exactly 5% of if you were to get it to here. But the thing is that when you combine the two, you're not going to find a lot of asset classes where $100,000 leads to this. And there's also, you're not going to be guaranteed to find an asset class that if you get to 1.2, it's going to be more than 5% kind of thing.
Yeah. Generally, you have to either choose growth or income in most investments. So it's rare to find one that has growth that you're seeing here and also income that pays you every single month.
Yeah.
So that's one thing to keep in mind. You know, the other thing to keep in mind is that, you know, this just general progression of how people typically invest, right? People typically invest in more risky assets while they're younger so that they can have better returns. And that tends to work for folks. According to Vanguard expects that the average portfolio, the 60-40 portfolio, will earn 7% returns, you know, over the next market cycle. So call that. They take on outsized risk and they earn a 7% return according to Vanguard. Well, what happens is you can't keep taking that outsized risk when it gets time to, you know, retire.
Yep.
So you have to move to something that is less risky, and you have to generally accept lower returns to do it. So if you ran these same numbers, you wouldn't be able to get to that same $5,000 by investing $100,000 in the stock market or, you know, 60-40 portfolio.
Yep.
You wouldn't be able to get to that same number.
Yep.
You would get to maybe similar numbers as far as market, you know, the value of your portfolio. But then, you know, if you're earning, call it, let's say 4% of a yield on something, it's not going to get you to as high of a rental income number or net cash flow number. So that's the change. That's a big difference from the way most people think.
Yeah, that makes sense. And I would even say that even in this abstract example of like getting there and then switching to this, Patron Santorius of our community brings up a really good point, and it's the idea that, like, let's say the move is you're trying to build up to like 1.289 million and then change it to bonds to turn it into cash flow. At that point, you'd go through a taxable event to convert it to cash flow.
Yeah.
So that 1.2 million would go down to whatever less, and then it becomes cash flow. So even then you wouldn't be able to just like pull it straight out. While this has been building the net worth while converting it to cash flow no problem. You're already there by the time you get there, right?
Good point.
Cool.
The tax savings of not having to dispose of an asset in order to get this type of cash flow is really, really critical.
Yeah, totally, man. All right, cool. We got a couple questions. You ready?
Yep.
Patron Centaurus of the community, Michael Centaurio says, Greg, after 27 and a half years, wouldn't it be better to sell and 1031 into another property and reset your depreciation?
That's a great question, Mr. Patron Santorios over there. So he's talking about a 1031, which allows you to defer taxes. You can actually sell a property and not pay taxes on it at the time of sale. What he's also talking about is after 27 and a half years, you typically have fully depreciated the property, which in essence means that you don't get as much tax savings in years 28, 29, 30, and so on and so forth. So he's bringing up a lot of good points. I wouldn't say it's necessarily the right move to sell. I wouldn't say it's the wrong move to sell. I think when we're talking 30 years out, life changes a lot, and you got to have access to a great team to support you and help you see all angles of it. A lot of things come to mind. Number one, if you were to sell and buy another property, the value of your cash flow may or may not be the same. Like, for example, if you buy another property, you might get more growth because you're using leverage, but you have less cash flow. So at that point in time, could you earn a better return on investment than hanging on to this property? You probably could, but I don't know if that's necessarily the right thing to do, because if you've held on to it for 35 years, right, you're probably in that phase of life where cash is way more critical to you than earning the highest return on investment. So I think it's something that is a case-by-case basis, and you just got to have a team of experts that you trust to be able to help you when you get to that point.
Okay, there you go. Brian McKay says here in the chat, I'm just saving capital for now, waiting for something to give, interest rates or home prices. But I'm noticing the new norm is 40% down. Rentals always used to be typically 25% down, less skin in the game. What do you say about that?
Yeah, I wouldn't say the norm is 40% down. I'd say some investors put 25% down, some put 40% down. It's depending on what's more important to you, Brian. So if you put 40% down, then you're going to be cash flow positive. It's going to be paying for itself and then some over time. So some investors put 40% down, some put 50% down because they want to make sure it's cash flow positive. It's paying for itself every single month. But what do those investors give up? They give up growth potential. They give up return on investment. The more that you put down, the lower your return on investment expectations are. And so those who put 25% down, was just working with a client not too long ago, very high income earner. And he said, well, I understand I'm going to be cash flow negative, but I'm excited to put 25% down because I ran the numbers after 20 years and I saw that my portfolio is going to be worth hundreds of thousands of dollars more in that example. So yeah, I wouldn't say it's a one size fits all. It's a part of the process for us to help you decide what's right for you. And a lot of that comes down to asking you the question, what's more important to you right now? Yeah. Income or growth? And then we build the right portfolio based on that.
Yeah. And that's the first question that you get asked when you book a call at chatwithjwb.com, book a call, you get on there, and that's where it starts, right? Like it's this idea of what's more important to you. And then you start looking at, and how much do you have to, and where do you have other sources of revenue? So they start building the portfolio for you based on more assets than you probably thought that you had available to invest into this stuff, and B, your priorities and what you're trying to do, right? So,
100%. Brian, it sounds like you have some great questions. You had a good time to really start that conversation with us. So I would encourage you maybe even to reach out to Madison or go to chatwithjwb.com, because starting that conversation even before you're ready to invest is perfect.
Yeah, totally. What about what he said there? I'm just waiting for something to give, whether it's interest rates or home prices. What do you say about that?
I think a lot of people are thinking that way.
Yeah.
I mean, I think people have been waiting for home prices to give for how long now? Right. Year and a half now. Right.
Yeah.
And I mean, we've talked about it for a year and a half, right? Home prices are a factor of supply and demand. And when we talk about interest rates being higher than anybody expected for longer than most people expected, and the fact that home prices have still gone up, that should tell you that there's something working that is keeping the price of homes elevated.
Yep.
And what it is it's an extreme lack of supply. And so interest rates affect demand. When interest rates are higher, it lessens demand. And so the number of home sales has come down from last year and the previous year, as we would have expected. But there's just simply not enough inventory to support the lower demand that we have, because it's been artificially driven down by very high interest rates. So I think if you're waiting for home values to go down, I think you're going to be waiting for a long time. And I think you will probably wait and, miss out on an opportunity to further your financial portfolio. Because think about it this way, interest rates now are in the 7s. For JWB clients, we still are able to get interest rates at 6%. But for the general public, right, 7% interest rates is what you might pay on a piece of real estate for the loan for a piece of real estate. What do you think is going to happen when those interest rates come down? What do you think is going to happen to home values when interest rates come down? I mean, it is the most sensitive part of the real estate world is what interest rates are doing. And the interest rates are way higher and home values are still going up in many markets, Jacksonville being one of them. So I think what's much more likely to happen is that home values are going to stay kind of normalizing, doing what they're doing right now, which they're slightly up for the year. And in Jacksonville specifically. And then, at some point, interest rates are going to come down. And I think it's way more likely that home values are higher than they are today, in 3 years than the alternative. And that's what the supply side is telling us.
Yeah. He's looking forward to buying his second home, but wait, he's feeling out the market, which I think it's fair. I can tell you, man, from my purview, I've just seen this in other markets where prices have gone up and up and up and up, right? Like it's kind of become a trope that I always talk about Miami, but like I keep seeing it there. And it's always very clear to me that when the market has these like big tailwinds, it's just going to continue to go up, right? And I think that we are somewhat spoiled. I don't know. I guess it's cognitive bias based on the fact that we all lived this like one blip where it went down. So we think that we're entitled to that every certain amount of time. But at the end of the day, that blip that went down was so shocking to everybody that it actually happened, that it sent the world into turmoil. So it's not something that anybody in their lifetime thought that would happen. So the fact that it would happen in another lifetime seems, seems a little bit shocking. And then on top of that, I also think we just took the biggest haymaker that interest rates could give us. Like interest rates just went up at an insane amount.
Yeah.
And it's still hard to buy a home because they're still feeling like it's overpriced because they're still going up.
Yeah.
Right. So like, I don't know, man. My thing. My thing is like once interest rates flip, then it's going to be that home, this $250,000 home is immediately going to be like $300,000. We're like, oh crap! It's
going to be a huge surge in demand.
Grand. Yeah,
it's going to be a huge surge in demand.
Correct. Which is going to make the price go way up, which is going to make you think, oh man, I should have gotten in before this happened, right? Like, anyways, that's my thought.
Yeah, I think that's very possible. Yeah. And then you're not even taking into account the market that you're potentially investing in. Correct. And all of the positive things, the things that could lead to higher than normal home price appreciation. So yeah, I've been saying it for years that I didn't expect home values to go down. I think we were like part one of people out there saying it. And it's worked out that way because we simply look at supply and demand, and that's what it's telling us. Yeah.
And Brian even brings it up himself. You can always refi, right? That would be my move. It's like get in now so that you don't lose that equity that's going to happen the moment that interest rates flip, refi later.
Yeah.
Date the rate, marry the asset.
There you go.
That's what they call it. Last two questions, GC. Good question, Brian. Like I love the back and forth, man. I'm happy that you're bringing this to us because it helps us articulate this stuff, and I think it's really valuable for everybody. Mm-hmm. If somebody not named Brian's hearing this and it's making sense to you, go to chatwithjwb.com and get that conversation started as well.
Perfect.
Asks, stipulating your investment advisor disclaimer. Do you have any revised projections of property values in Jacks for the next 3 years, given the anticipated commercial improvements to downtown?
What I've been saying is that I expect home values in 3 years to be much higher than they are today. Hard to give expected home price appreciation rates when you're only going out 3 years. Generally, people are just guessing at that point, right? Too many variables, but that's why we stick to the long term, right? The 10 to 20 year market cycle. And that's where you see all of our projections come in. It's because data shows us for 10 to 20 year segments of time that you can count on that. So I don't have any numbers for you in 3 years other than I think they're going up.
All right. Billy Green also asks, here in Denver, there seemed to be a direct correlation of population and property growth that matched the winning season of the Denver Bronco franchise. In your opinion, do championships of major sports teams boost the values of the area? And is this a potential reason to become a Jags fan?
You know what? I don't know what the numbers are on it, but I'm going to say yes, right? I'll tell you, one of the things that is related to a sports team, and I think really boosting values, is when a sports team makes a significant investment in the local economy and revitalizes not only their stadium, but the surrounding neighborhoods, which is what we have here with the Jacksonville Jaguars. We have an ownership group and a leadership group within the Jacksonville Jaguars that is absolutely willing to revitalize, to put their own money into revitalizing neighborhoods around the stadium, which is just unheard of, right? It's not normal for a sports franchise to think that big picture. But Shad Khan, who's the owner of the Jags, and the president, Mark Lamping, who we were honored to have on the show not too long ago, have shared their vision that they want to do well, of course, for the Jags, but they want to do well for the city of Jacksonville. Yeah. And if you start to put the pieces of the puzzle together, right, the Jags are playing in London this weekend. They played in London last week, and the Jags have a relationship or have an agreement with the NFL. They've been able to play one of the London games every year for a while here. You can start to see this beautiful plan coming together where the Jags franchise will do better when the city of Jacksonville does better, and our ability to be recognized overseas and potentially having, a direct flight to London, you can start to see all those things come together. And it's just like a beautiful master plan. Yeah. So I'm very thankful that we have an ownership group, that we have Shad Khan as the owner and a leadership team within the Jags, because I absolutely think that will have an effect on home values.
And I'm just saying, but I think Trevor Lawrence is a better quarterback than Peyton Manning.
Sure. He has better hair.
Better hair. All right. Agreed, man. Right. Like betting on whatever effect John Elway and Terrell Davis and Peyton Manning and Von Miller had on the property values of Denver are lesser than the effect of, this idea of people investing in these public spaces, these experiences in downtown, right? Like these businesses coming there, median incomes going up in Denver, thanks to Boulder and like all the tech scene that's happening, the quality of life in Denver and people wanting to live and like play in the mountains with like really good weather for such high elevation. I would venture to say that those things are really what move the needle more. And yeah, winning football doesn't hurt at all.
I would agree.
Yeah, cool. All right. Last thing from Michael Santoris here. He says, Gregg, thanks for answering so many questions during the show, but Allie King answered just 25 questions in the last 15 minutes of the show she co-hosted. Just saying.
I was telling Allie, I don't think I'm going to be welcome back to the show. She did so well. Dude. I mean, she's just dynamic. We're so happy to have her on our side. I'll say that. Isn't she just awesome?
Man, I was literally quality controlling that show this morning, and then I ran into Allie. I'm like, Allie, I've been listening to you all morning. Yeah, man. It was so good. I mean, the understanding of the property turn and how she explained it and the way that she was just firing it off. And it was the same thing. It was like 30 minutes of explanation. And then it was like rapid fire question. And you've
been trying to train me to do that for 3.5 years now. And I stink at that. So
if you say so.
Well, thank you to all of you, because that show came from you all. It was something that you asked for. And let's face it, it's not a fun topic to talk about is when your property is turning over. But that's where the show can really be of value. So other thoughts, other questions, other shows that you would like, please continue to send those in. Please. You can either send those to Madison right on the chat right now. You could send it to info@jwbcompanies.com and just send us an email. We want to know, because it'll help us continue to do better and better for the show.
You have trained us to believe that if it's your idea, you show up and it leads to good things. True. And we have bought in on that 100%. So we love when the audience participates. We love the fact that you've just spent an hour here with us. We had over 60 people on this call throughout this whole thing. It's Thursday, middle of the day. We never take that for granted. GC, I'm so pumped to be back in studio with you, buddy.
Me too, brother.
Madison and here with the community, man. This is great. This is just a different energy, man.
It's so wonderful to be back rolling and just doing things that we normally do. I'll tell you, it's been a journey to get back. And this is kind of like the final piece for me of us being in the studio and being back to work this week. So thank you guys for making this such a special thing for myself and for everybody on our team here.
Got it. I see Serge Bourbeau is asking where he can find the past show recordings. They're all on YouTube, buddy. If you go to NotYourAverageInvestorShow.com, you see all the past show recordings. If you put Not Your Average Investor Show in your podcast platform, you can find it on audio if that's what you prefer. We'd love to have you there. Today's show right now is live on YouTube, so you can go re-listen today if you go to the live tab under the JWB YouTube channel. So
They search for either JWB or Not Your Average Investor Show
yeah,
on
if you put
YouTube.
Not Your Average Investor Show, it's going to take you to the JWB. It's the JWB channel.
Yeah.
But Not Your Average Investor Show will bring you to us. Faux show.
Love it.
So until then, this Tuesday, we've got another really, really great show. We are bringing up all of the biggest questions they ask on sales calls out here. All the most asked questions by folks. We're going to talk about them on Tuesday. I think it's going to be
fantastic.
Really,
Get
really
your popcorn ready.
Yeah, Lauren Alleman sent me a little document with all these like things that everybody keeps asking all the time. And I was like, ooh, idea. The moment that Gregg is back, we're doing a show about it. So we're answering your questions on Tuesday. Bring extra questions because we love answering them. But the one thing that I'm asking you not to do before next Tuesday is what, GC?
Don't be average.